To part B of the question. Part B reads, an unlevered firm operates in a perfect market and has a net operating profit of 4 million shillings. The required rate of return on assets of this firm is, in this industry, is 16%. Assume that the firm issues 10 million shillings worth of debt with a required rate of return of 14.5% and uses the proceeds to repurchase outstanding shares. There are no corporate or personal taxes required. Roman 1. The market value and required rate of return of this firm's shares before the repurchase transaction according to MM proposition number 1. 2 marks. Part B. Roman 1. We are to calculate the market value of this firm and the required rate of return, 2 things. So the market value of the firm, we know the formula is EBIT over the cost of equity. EBIT over the cost of equity. And this is the cost of equity of the unlevered firm. This firm is unlevered. All right? And therefore, the earnings before interest and tax is 4 million. The cost of equity is equal to the required rate of return, which is 16%, 0.16. So that will be the market value of this firm. 4 million divide 0.16. It's 25 million. That is the market value of this firm. The next requirement is the required rate of return. The required rate of return of these firm shares before the repurchase. The required rate of return. The required rate of return. The required rate of return. The required rate of return of the firm shares. The required rate of return of the firm shares. The required rate of return. Required rate of return is equal to W, the weight of KE, plus the weight of KD. There are no taxes. All right, there are no taxes. So candidate, the required rate of return of an unlevered firm is the same as the the weighted average cost of capital. So the weighted average cost of capital will be equal to the weight, which is 25 over 25. This is the weight. There is no debt. So 25 times 25, the cost of equity is, we read the cost of assuming the firm issues that required rate of 14, this is 16 plus 0. This will be equal to 16%. So the required rate of return of an unlevered firm is equal to the weighted average cost of capital, which is equal to the weight of cost of equity plus the weight of debt But since the farm is unlevered, there is no debt. That's why I've put here 0, and therefore the weighted average cost of capital of this farm is 16%. Now moving on to part 2 of the question, the market value and required rate of return of this farm's remaining shares after the repurchase transaction according to MM proposition 2. So the market value, this is Roman 2, the market value, or let me just say the value of the farm will be equal to the value of equity plus the value of debt. Value of equity plus value of debt. The value of equity plus the value of debt. Now, the value of equity is, after repurchase, is 15 million. And the value of debt after repurchase is 10 million, which is equal to 25 million. Because we read that assuming the firm uses 10%, 10 million worth of debt with the required with the required rate of return of 14%, and uses the proceeds to repurchase outstanding shares. So the value of the firm is still equal to 25, is the value of the firm. The next part we need to answer is the required rate of return. That is the cost of equity of a levered firm. This firm is levered because there has been introduction of debt in the capital structure of this company. This will be equal to the cost of the unlevered firm plus the cost of the unlevered firm minus the cost of debt times the debt equity ratio. The cost of unlevered firm, we had calculated it here, 16% plus 16% minus cost of debt 14.5% from the question times the debt equity ratio. The debt is 10 million, equity 15 million. This is equal to 16 minus 14.5 times 10 divided by 15 plus 16. So this gives me 17%. So 17% is the cost of the levered firm of this company.